Good afternoon, everybody. Chuck Hughes here. Thanks for joining us today. As Adrian mentioned, we conduct monthly webinars the first Thursday of every month, and we look in depth at the various inner circle strategies. And today we're going to look at option spreads. And the option spreads have worked very well for us for many, many years. They seem to work in just about any type of market condition, whether it's a bull or bear market. Back in the last bear market, we had a lot of bearish spreads on for a lot of different global markets, currency markets, equity markets, and we did very well in the last bear market with option spreads. And around March of 2009, we started putting on bullish spreads, and we did very well with the bullish spreads. And then in 2010, 2011, we had really volatile markets, and there wasn't always a price trend in 2010 and 2011, but we were still able to profit using our option spread. So this has been a great strategy for us over the years, and seems to work in all kinds of different types of market conditions. And our option spread portfolio currently has a really great return. It's in the we'll take a look at the open positions here in a minute, but it's around an average return of 190%. So again, it's performing very well. And option spreads are created when you buy and sell a call option with the same expiration date, and that's known as a bull call spread, or you buy and sell put options with the same expiration date, and that's known as a bearish put spread. And we trade debit spreads, and with a bullish debit spread, you buy a call option, and then you sell a call option with a higher strike price. I'm going to show you an example of that. I bought the Goldman Sachs July 65 strike call, and I sold the Goldman Sachs July 95 strike call. So the sell strike price was higher than the buy strike price. So this is what's known as a bullish debit spread. And your risk with a debit spread is limited to the cost of the spread. So now there's two ways you can trade these spreads in general. You can buy the call option and sell the call option simultaneously at the same time to create the spread, or you can leg into a spread. If you purchase an option and you have a profit in the option, at a later date you can leg into the option spread by selling a call option with a higher strike price. And in the inner circle, we do it both ways. We initiate some spread simultaneously with the buy and the sell on the same day, and then other times, if we have a profit in the option portfolio, we'll go ahead and sell a call option against our existing option purchase. As a matter of fact, we just did that today with Ross Stores. We had a profit in our Ross Store option purchase, so we went ahead and sold a call option today to create a spread, and that has a lot of advantages that we'll look at in this presentation. So there's two ways to do the option spreads. You can do the buy and sell simultaneously, or leg into the spread. So if you do the buy and sell simultaneously, some of the advantages are that the call option purchased will profit if the underlying stock increases in price, and the call option sold will profit if the price of the stock decreases. So with the spreads, the long call, of course, profits as the stock increases. The short call profits as the stock decreases. And but your risk is always limited to the cost of the spread. So this is considered a limited risk strategy. And if you trade in the money call option spreads, that's another strategy that we've used in the past, especially during volatile markets or when there's no clear trend. If you go in the money or deep in the money, you can provide substantial downside protection in case that stock declines in price, and I'll show you examples of that. And when you trade these in the money spreads, that can really increase the accuracy of your options trading compared to at the money or out of the money spreads, because the in the money spreads provides a lot of downside protection, and you can hold your position during volatile price swings. So that's the advantage of in the money calls. The return is not as high as doing an at the money spread or an out of the money spread, but if you do an in the money spread, your downside protection increases, and the accuracy of your trading is going to increase. You're going to have a higher percentage of wins. So there's a trade-off there. And 2010, 2011, we were doing a lot of these in the money spreads, deep in the money spreads that came through for us because we were able to ride out the volatile price swings and still get a good return for the spread for the risks that we took. Okay, here's an example of an option spread that I initiated simultaneously at the same time. Bought the Goldman Sachs July 65 strike call at 50.63 and sold the Goldman Sachs 95 strike call at 27.93. So this created an option spread, buying the 65 strike, selling the higher strike 95, created a bullish debit spread, and the cost of this spread was $22.70, and that's calculated by subtracting the premium received for the sale, in this case the 95 strike at $27.93. You subtract that from the cost of the option purchase, in this case the 65 strike. So if we subtract that premium received from the premium paid, we get a cost for the spread of $22.70 or $2,270. So this spread was initiated the buy and the sell at the same time. Now, when I sold this 95 strike call, I received 27.93 points of premium, or $2,793 in cash for each contract. So that's cash that goes into your brokerage account immediately, and I received a total of $16,750 in cash for 6 contracts, and you get to keep that money no matter what the underlying stock does. So buying the 65 strike call at 50.63 and selling the 95 strike at 27.93 resulted in a 55% cash payment I received up front. In other words, this 27.93 is 55% of my cost. So I'm receiving a 55% cash payment up front when I sell this 95 strike call. So, and again, I get to keep that cash payment regardless of the price movement of the underlying stock. And I later did an analysis. Goldman Sachs stock moved up in price and was trading at around 140. So I did an analysis of this spread based on the current price of the stock. And again, I received 55% cash payment, which reduces your risk and it reduces your dollar amount of risk, and it reduces the overall risk of the option purchase. In other words, if you just did an option purchase of the 65 strike, you have 50.63 points of premium at risk. But by selling this 95, it reduced this 50-point risk to a 23-point risk. So it reduces your risk and your dollar amount of risk, and at the same time provides downside protection. And the call option spread analysis will give you the return potential on this bottom row here for various price changes in Goldman Sachs stock, from a 5% increase to a 30% decrease. So if Goldman Sachs stock went up, this spread had a return potential of 32.2%. It stayed flat, 32.2%, and even if it declined in price, we still have a 32% profit potential with this option spread. And again, this was a deep in the money spread, so this was fairly low risk, and but I still got a decent return. And I took this when the markets were still volatile, so a 32% return with fairly low risk at the time. That to me, that's a good reward versus the risk profile for this trade. So these spreads are versatile in that if you have really volatile markets, you can do them deep in the money. If you have trending markets, you can do it closer to at the money. And today, the raw store spread we did was actually an out of the money spread. So you can adapt these spreads to the current market conditions, and 32% return when we had those wild price swings, a lot of volatility, no trend. That was a good return. Now, the other thing we like to do with these spreads a lot of times is we'll roll the spread over, and when we do that, that reduces the cost basis of the new spread and reduces our risk, and we get to compound our return. So that's a big part of the option spread strategy in Inner Circle, is rolling over the current spreads into the new spread, and at a reduced cost and an increased return potential because of the compounding. So in the case of this Goldman Sachs, that was a 4-month spread. So if I rolled that over 3 times in the course of a year and got a similar premium, then those 3 spreads have the potential of producing 165% cash-on-cash return over that 1-year period. It was, if you remember, it was 55% for the trade that I took, the July trade. So if you rolled that over 3 times, then you get 3 of those 55% cash returns, or a total of 165% potential cash-on-cash return with these, by rolling over these option spreads. Here's another example for ISRG, and this again was a deep in the money option spread, and this was done on March 25th, this was for the April option, so this was only a 3 or 4 week. This is about a 3-week trade actually, and ISRG was trading at 330, so this was a deep in the money call, 3 weeks, and so this was a fairly low risk trade. Again, with ISRG trading at 330, I bought the 250 strike call, sold the 280 strike call, and so that was deep in the money and very short term, but still it returned 19%. And whether the stock went up 15% or down 15% at option expiration, this spread returned 19%. And here's an example of the bearish spread. And again, the bearish spreads are created when you buy a put option and you sell a put option with a lower strike price. And in this case, with ISRG trading at 330, I bought the 400 strike put and sold the 370 strike put. So these were deep in the money for puts with the stock trading at 330. And again, this was over about a 3-week period. I had this spread on. Now with the bearish spreads, the put option purchase profits if the price of the underlying stock decreases, and the put option sold profits if the underlying stock increases in price. So you have upside protection with a bear put spread. And again, your risk is limited to the cost of the spread. So here's the bearish spread, buying the 400 strike put, selling the 370 strike put. And again, this was deep in the money. It was about 3 weeks to expiration, and this had a 20% return. If the stock went down 10% or up 10%, well, if it went down 10%, it had a 20% return. If the stock went up 10%, this spread would have had a 26% loss. So if it stayed flat, 20% return. So it did provide some downside protection if the stock, or I should say upside protection. It provided upside protection if the stock went up in price. Up until about a 10% increase in price, then the spread would start losing money. So again, this was a short-term spread and deep in the money for a put spread. Now let's talk about legging into spreads. And again, we do a lot of this with the inner circle option portfolio. If we have a profit, at a later date, we'll leg into the spread, and that has a lot of advantages that we'll look at here. Legging into the spread has a lot of advantages, and if you leg into the spread, one of the advantages is you increase the profit potential of the existing option purchase, and we'll take a look at some actual trades that I took, and you can see that you can increase the profit potential by up to about 100%. In other words, the existing profit that you have on the option purchase, you can increase that potential by about 100%, and I'll show you some examples of how that profit potential is increased. And then, of course, when you sell a call option in a bullish spread, you provide downside protection in the event the underlying stock decreases in price. So if you just do an option purchase, of course, the price of the stock has to go up or you're going to lose money. But if you do an option purchase and then later leg into a spread by selling an option, then you get downside protection, and then you can even make money if the stock declines in price. And of course, with an option purchase, you cannot make money if the stock declines in price. The stock must go up in price to make a profit with an option purchase. So by legging into these spreads, we not only increase the profit potential, provide downside protection, but we really increase the percentage winning trades by creating a spread. And here's an example of a Google spread that I legged into. You can see from my brokerage confirmations, I bought the 570 strike call at 37.35 on October 4th, and then I sold the 640 strike call at an average price of $28.65 on October 18th. So that was 2 weeks later. So I had a profit on my Google option purchase. 2 weeks later, I sold. This was actually an out of the money call at $28.65, and of course, out of the money calls consist of only time value, and at option expiration, the time value decays to zero, and that this $2,865, that becomes all profit at option expiration no matter what happens, because it was an out-of-the-money option sale consisting of 100% of time value. So, and these were, I sold these options on October 18th, and they were the November options, so this trade only had about a month to expiration. So, again, purchased the 570 strike call at 37.35. The price of Google stock increased. So then 2 weeks later, I wanted to protect this profit I had. So I sold the 640 out of the money calls at $28.65. And again, they were all time values. So that $2,865 was time premium, which becomes all profit a month later at expiration. Now, when I sold this 64 strike call and legged into this spread, my existing option purchase, the 570 strike purchase, it had a 33.70 point open trade profit. So I had a good profit in this 570 strike purchase, but when I sold the out-of-the-money 640 strike call at $28.65, that $28.65 is 85% of my existing profit. So I increased this existing profit potential 85% by selling this 640 strike call at $28.65. So in this example, your profit potential increased 85%. And of course, the sale of the 640 strike call provides this 28 points of downside protection at the same time. So here's what the call option spread analysis looked like at the time I took the trade. Google's trading at 639, sold the 640, so that would be, I guess, the at the money or slightly out of the money call consisting of only time value. And you can see there was about a month to expiration with these. You can see if Google stock goes up, this spread had a 704% return, and if the stock stayed flat, had a 693% return. Stock goes down 5%, 325% return. So again, buying that 570 strike at 37.35, but then later selling that 640 strike at 28.65, I reduced my risk from $3,735 to the cost of the spread after selling this premium here. I reduced my total risk from $3,735 to just $870. So my total risk was greatly reduced from $3,700 to $870. I increased my profit potential, as you saw, 85%, and the spread profit on this $870 at risk was $6,130. So a lot of benefits to legging into these spreads, as you can see. And So I reduced this dollar risk from 3,700 to 870, increased the profit potential. Now I have a 704% profit potential on the trade, and I believe it was 16 contracts. So this turned out to be a $100,000 profit on this option spread trade. Here's another example of a spread trade I legged into. I bought the Apple 345 strike call on July 8th at 28.17, and then July 19th, 11 days later, I sold the 375 strike call at 24.55. So I reduced this risk of $2,817 to about $360 by selling the 375 strike call. So here's the call option spread analysis for this particular trade, and by legging into the spread, I increased the profit potential of my 345 strike purchase by 110%, reduced the risk from $2,800 to $362, and also this is very important. It enabled me to hold this position during volatile price swings, and this was last year in July of last year, which the markets are pretty volatile then. So I was able to hold this spread during those volatile price swings and realize the full profit on this spread. And again, if you just do an option purchase and you have a profit, you may give some of that back during these volatile price swings, or you may even get stopped out using our money management principles. So overall, it's much better if you have a profit on an option to go ahead and create a spread. If you're able to do that in your brokerage account, and you not only increase your profit potential, but you drastically reduce your risk, and you can hold that position during volatile price swings. So overall, this is a great strategy. It's worked very well for us over the years. And again, we'll just recap the. By legging into a spread from an option purchase, you increase the profit potential of your existing purchase. You provide downside protection in case the stock goes down in price. And here's another example. This was during, this is for Cliffs Natural stock. You can see a lot of price volatility here, but the stock over this period was essentially flat. So I did an option spread on this. I bought the Cliffs July 50 strike call at 1975 on April 3rd, and then I went ahead and sold the 65 strike call. This was 2 weeks later. On April 17th, I sold it at 1945. So now, by selling this 65 strike call, I reduced my total risk to just 30 cents, and I can hold the spread. It has a lot of downside protection, so I can hold it through these volatile price swings. So a lot of good advantages to these creating these option spreads through a leg-in. And again, I was able to maintain my positions during volatile price swings, and they can be profitable if the stock goes up or down depending on the strike price that you sold. So a lot of advantages to doing these option spreads. And here's a snapshot of our current portfolio. This is as of a day or two ago, and we had 151,000 in open trade profits, average return of 194%, and so that's a great return. And what we've been doing is rolling over a lot of our profitable spreads. And again, by rolling over, that allows us to compound our returns, reduce the risk of the new spread that we initiate, reduces that dollar risk, and then allows us to compound our return. So that's how we have such a high average return for these spreads, 194% for our inner circle spread portfolio. And I took this snapshot last night. This is for Ross Stores. We initiated a new option spread on this today, and I just wanted to show you what an option spread order looks like. Last night, Ross Stores was trading at 63.85, so we created a spread by buying to open the August 50 call, and we sold to open the August 67.5 strike call. So that created an option spread. And now we already owned a Ross store option. We owned the May option, so we rolled over from the May option into an August 50 strike call. So it reduced our cost basis of this 50 strike call by about 7 points. We had about a 7-point profit, existing profit in our Ross store option purchase. So we went ahead and we sold to open the 67.5 strike call. And if you're a newer member and you don't have this Ross store option, you can certainly initiate the spread trade, and you would do it by using an order similar to this. And if you're just initiating the spread for the first time, this is what the call option spread analysis looks like for this trade if you just initiated it at the current prices. And you can see it had about a 41% return potential, and if the stock just stays flat, 12%, if the stock goes down 10%, then the spread would start losing money. But by legging into the spread, in other words, we already owned a Ross Stores call option, and we had about a 7-point profit, so that reduced the buy price of our 50 strike purchase, of the August 50 strike purchase. Now you can see that really changes the profile of this trade when you leg into it, because now with our reduced cost basis, if you have any increase in the stock price, you're going to get about 190% return. If the stock stays flat, 136% return. Stock goes down 10%, a 27% return. So you can see by legging in, that changes the whole profit potential and money at risk by legging in to an existing option purchase. So okay, that concludes my presentation for today, and I'd be glad to answer any questions that you may have. And
Chuck, I do not have any questions either in the chat or the Q&A area.
If you have any questions, you can always call or email us, and we'll be glad to help you out with the Inner Circle Advisory. So I want to thank everybody for attending. I wish you a great day.